that we're in a depression right now.
Okay.
It will last for a long period of time. But a lot of people get confused, and one can understand why, about the difference between a recession and a depression.
Yeah. Please.
Most mainstream economists, they don't like what I call the D word. They don't talk about depressions. They talk about recession. So a recession is conventionally defined as 2 or more consecutive quarters of declining GDP. And this would be the first back-to-back recession since 1980, 1981. So you have a recession, you come out of it, and then you go right back down into recession. So that's technical recessions. Depressions are different. And a lot of people think, well, if a recession is 2 quarters of declining GDP and a depression is worse, well, a depression must mean 10 quarters of declining GDP, as if it's a really long recession. And that's not the definition. The depression means depressed growth. Growth is depressed relative to trend, relative to potential. So you can actually have growth in a depression, but the point is the growth is too weak. And so this is what we're in. We had the third quarter, when you went down that sharply, you were going to come back pretty steeply. That's natural. But we didn't come all the way back. People say, well, okay, you went down 31% and you went back up 33%. So aren't you back where you started? And of course, the answer is no, because you're applying the 33% to a smaller base. So if you normalize, let's say 2019 is 100% of 2019 output. You go down 5%, and then you go down 31%. Well, now you're around 65% of the prior output. Well, if 65 is the new base, and you go up 33, that adds 21 or 22. But you're only back to 87 because you're working off a smaller base. Even if you have, in my example, 10% growth in the fourth quarter of 2020, it's 10% of 87, so add on 8 more. You're only back to 95. So a simple way to understand it, you fall into a 50-foot hole, you climb out 20 feet, well, that's good climbing, but you're still in the hole. You're not back to where you started. But a better comparison is maybe Japan. I would say Japan has been in depression since 1990.
Yeah.
Now, it doesn't mean, now they had growth and recessions and growth and recessions. You can have 2 or more recessions in a depression with periodic growth, but the point is you never get back to the old potential. I mean, good example, the Japanese stock index, the Nikkei index, in New Year's Eve 1989, it was 40,000. Today, 30 years later, it's about 28,000. But okay, it came off the bottom, but it never made it back to the prior high.
You'll never be.
Oh, I think that's right. It may never be. And another example, in October 1929, the United States stock market crashed, a very famous crash, but it lasted for 3 years, and when it bottomed in 1932, it was down 89.2%, almost 90%. That's what a stock market crash looks like. But then you ask people the next question and say, well, when did it get back to the 1929 high? How long did that take? The answer is 1954. It took 25 years to get back to where. Now, it doesn't mean you couldn't make money in the meantime. You could have bought the low in 1932 and made money in 1933. But that's what depressions look like. That's the kind of thing we're in. This will be intergenerational. The effects of this will last for not 30 months, but 30 years. And there's very good evidence to back that up. There was a group, it was an economist at the Federal Reserve Bank of San Francisco and 2 academic economists, and they looked at all of the pandemics in the last 650 years, going back to the Black Death. I often criticize economists because their time series are too short. They say they're doing correlations and regressions. They say, well, no, we need a much bigger time series. Well, 650 years is good enough. But they went back to the 1350s, to the Black Death, and they looked at every pandemic in which 100,000 or more people died. The fatalities were 100,000 or more. Of course, the 2 worst were the Black Death, the plague in the 1350s, and the Spanish flu around 1918, 1919. The Black Death was about 75 million dead, they estimate, and the Spanish flu was 100 million dead. And then after that, there were several where there were 2 million fatalities and some fewer. They were using 100,000. Well, there were only 15 pandemics in the 650 years where 100,000 or more died. COVID-19, by the way, is going to end up being 3rd on the list. Right now, it's 5th, but we have over 1.8 million fatalities, but it's not under control. So you can see that number is going to go past 2 million. it'll pass the Asian flu, and there was one other influenza in the late 19th century. So it's going to be third on the list. But what they asked themselves, because they're economists, not doctors, and they said, well, how long did it take these economies to normalize following these extreme pandemics? And the answer is, on average, 35 years, not 35 months. And just to kind of give a concrete example of that, so I grew up in the 1950s, 1960s. It was a very prosperous time in the United States. I did not live through the Great Depression, but my parents did, and my grandparents did. So I was raised with a sort of depression mentality, even though I didn't live through it. And when we were little kids, 9 years old, my parents would send us out. We'd take our wagons and go door to door and collect tin cans and newspapers. And we weren't doing it for environmental reasons. It might have been good for the environment, but we were doing it for recycling, because all that stuff could be turned into buildings and so forth. And so, as I say, and that didn't change until the late 1960s, when the baby boom came of age, and then we just started partying and using credit cards and everything else. So it did change, but it took 30 years to change. In other words, the behavioral and adaptive effects of the Depression of the 1930s lingered through the 1960s. And that's my experience, but it's consistent with what these researchers found out. But at the end, when we get to asset allocations, I said the first thing I do is I explain my methodology and explain what diversification is. Diversification is a very powerful tool. It does what it's supposed to do, which is increases your total return with less risk. But people don't understand how to diversify. I run into people, they say, well, I'm diversified. I own 30 different stocks in 10 different sectors, technology, consumer non-durables, minerals and mining, et cetera. And I say, you're not diversified. You may have 30 stocks, but you're in one asset class called stocks. So and stocks are they'll go up together. I'm not saying they'll go up together and go down together. So you may have 30 stocks, but you're not diversified. Diversification is, okay, have a slice for stocks, that's fine. Gold, cash, real estate, treasury notes, and alternatives. That is closer to real diversification. So in particular, I recommend about a 10% allocation to gold. And people always want to put words in your mouth. They say, well, Jim Rickards says sell everything and buy gold. I've never said that. I don't believe that. But a 10% allocation, I think, is right. That will, if there is extreme inflation, that will produce gains that are so large, they'll kind of insulate the rest of your portfolio. So you're protected that way. And if there's a loss of confidence in the dollar or some kind of currency collapse, again, gold will do very well. I also recommend 10-year treasury notes, or for the German investor, bonds, 10-year bonds. And the reason for that is, first of all, they're high credit, they're liquid, but interest rates are going to go lower, which produces capital gains. It's a little bit counterintuitive. People don't understand bond math, but it's pretty simple. If interest rates go down, the value goes up. So as interest rates go down, you're getting more capital gains. So we have a lot of, very smart, very prominent people in the United States, Jeff Gundlach, Bill Gross, Dan Isaacson at PIMCO, and others who say, the interest rates are too low. This is the greatest bond market bubble in history. Short the bond market, et cetera. One by one, they've been carried off feet first. They've been wrong about that. And the reason is they confuse real rates and nominal rates. So nominal rates, that's the rate you see on television or when you look at a screen. That's the nominal rate. But the real rate is the nominal rate minus inflation. And the problem is nominal rates are low. That's true, but real rates are not low. I borrowed money in 1980 at 13%. That was my first mortgage. My mother cried because her first mortgage was 2%. But I said, Mom, I'm borrowing at 13%, but inflation was 15%. So my real rate was -2. Plus, taxes were 50%, 50, and my interest was tax deductible. So I got a tax benefit on the money I was paying of 50% on the 13%. So that's another 7%, 7.5%. So my after-tax rate, after inflation, after taxes, my real rate was -8. So I was borrowing at 13 nominally, but my real rate after taxes and inflation was -8. That's a low real rate. But the point is that that's where we have to get to. If you want to stimulate the economy and borrowing and lending and spending and investment, et cetera, you have to get real rates much lower than they are right now. Well, we're not getting inflation. Eventually we may, down the road we may, but not now. Deflation is a greater danger. So if If inflation is declining, we're getting disinflation and deflation, and the nominal rate is here. How low does the nominal rate have to go to get to a negative real rate? Well, it's got to go negative. It's got to go maybe -2 or -3. That will produce enormous capital gains for the bondholders. The problem they're trying to solve is the following. We know from a long series of experiences, 30 or more business cycles since the end of World War II, that when the U.S. is in a recession, you have to cut interest rates 3 to 4% to get the U.S. out of a recession. You need 300 to 400 basis points of cuts to get the U.S. It's like a plane heading for the ground. How do you pull it out of a nosedive and get it back up in the sky? The answer is 300 basis points of cuts. How do you cut interest rates 300 basis points when you're only at 75 basis points? The answer is you can't. And forget about negative rates. The evidence is now pretty good that negative rates do not work. In other words, negative rates are not more of the same. When you go from, let's say, a half of 1%, then you go to a quarter, and then you go to 0, and then you keep going to -25, you didn't just ease by another 25 basis points. The evidence from Japan and Europe is that you're through the looking glass and you have very strange effects, really unintended consequences. I'll give you a couple examples. So the conventional theory is, well, the more I cut interest rates, the more stimulus I get. That's a joke, but that's what they think. But if I go negative, you're absolutely going to go out and spend the money. Because if you don't spend the money, I'm going to take it away. You sit there long enough, you'll have nothing left in your bank account because I'm going to take, with these negative interest rates, I'm going to take it away. So people will run out and spend. And the other thing is that, it's obviously, from the lending point of view, they'll borrow money, because the bank pays you to be a borrower. But here's what happens in the real world. This is the difference between academics and human beings. When people see negative interest rates, people have goals in mind. They have lifetime goals, right? They want kids' education, parents' health care, their own health care, retirement. If you start taking their money away with negative rates, guess what they do? They save more. They're like, hey, I got to put my kids through college. You're taking my money. Well, I better save more. And then what kind of signal is the central bank sending with negative interest rates? They're sending a deflationary signal. So people go, well, if you think it's going to be deflation, I'm not going to spend money. I'll wait till the price comes down. So you're trying to encourage lending and spending, and what you get is more savings and no spending, deferred spending. You get the exact opposite of what you want. So again, another egghead experiment gone awry. But the point being, so negative rates don't work. So zero bound really is zero. It really is a boundary. And Bernanke has said this in his recent writings, and I think he's right about that. So back to the problem. How do you cut interest rates 300 basis points when you're at 75? Well, the answer is you can't. So you have to raise them to 300 basis points. So the problem the Fed is trying to solve is how do they get rates to 3.25% before the next recession? Now, I'm not saying the Fed sees a recession, and that's easy because the Fed never sees a recession. In 102 years, the Fed has never seen a recession, never forecast a recession. But they know their economic history. We are 8 years into an expansion. It feels punk. I mean, the growth is anemic, but labor force participation is low, productivity is dropping. There are a lot of bad things going on, but in fact, we are in the 8th year, actually coming up on soon be entering the 9th year of an expansion, which began in June 2009. Right. Well, you have a hard time convincing most Americans that we're not still in a recession. Depressions are different than recessions. The technical definition of a recession is 2 consecutive quarters of declining GDP with rising unemployment, a couple other bells and whistles, little subjective factors, but that's basically it. So people, when you say depression, they're like, depression sounds worse than a recession. And if recession is 2 quarters of declining GDP, then a depression must be like 10 quarters of declining GDP because it's got to be worse. But that's not the definition. The definition of a depression, you can have growth in a depression, but it's below trend growth. In other words, if trend is 3.5, and you're actually banging out 1.5, 2, that gap between, let's say, 1.5 and 3.5% growth, that's depressed growth. It's an output gap. It compounds over time, and you never get it back. We are losing trillions of dollars of wealth. We are impoverishing future generations on a relative basis because of our inability to get back to trend growth. So the reason American people feel this and don't listen to the economists, and they're right, is because we're in a depression. So leaving that aside, the Fed at least understands the business cycle and the fact that the next recession, they say they don't die of old age, but they do die, and we're getting closer to the next one. So they are in a desperate race to get rates up to 3.5% before the next recession hits so they can cut them to get out of the recession. The question is, can you raise rates enough to cure the next recession without causing the recession you're preparing to cure? That's the dilemma. That's the finesse. My answer is no, they're not going to be able to do it, but they think they can. why are they in this box? Well, because Bernanke should have raised rates in 2010, 2011, in the early stages of the expansion, when the economy would have been much better able to bear it than it is now. Bernanke skipped the whole cycle. He skipped the whole rate increase cycle to pursue these wacky experiments and, QE and zero interest rate policy and all that. I spoke to Bernanke about this, and he used the word experiment. He said this was an experiment. Bernanke made his academic reputation by studying the Great Depression, in the wake of Friedman and Anna Schwartz and some others. But he was a great scholar of the Great Depression, and he got his chance to kind of try out his theories. But what he told me was, he said 30 years from now, some new Ben Bernanke, some young scholar, will look back and tell us if we did a good job or not. We actually don't know right now. See, the Great Depression was really two technical recessions, 29 to 33 and then 1937-38. But from 33 to 37, we had an expansion, but the whole thing was a depression because we never got out of it. The stock market recovered the 1929 high in 1954. It was a long time to get back to even. But Bernanke's mantra was, doing something is better than doing nothing. I completely disagree. It's better to do nothing if you don't know what you're doing. And this is really the monetary equivalent of the Hippocratic Oath. The doctors say, first rule of being a doctor is first do no harm. Anyway, bottom line is, by pursuing QE and zero interest rate policy, Bernanke failed to raise rates during the early stages of a cyclical expansion, which he should have done. If he had, the economy would have been just fine, and we'd be able to cut them today, but he didn't, so Janet Yellen now has to make up for lost time. So that's the mission, but again, and this is what the market completely does not get, and the Wall Street economists don't get, nobody gets this, because they see the Fed raising rates, and they've done the correlations and the regressions back to World War II, and they go, every time the Fed raises rates, the economy is getting stronger. So if the Fed's raising rates, the economy must be getting stronger, so bid up stock prices, etc. But that's like saying umbrellas cause rain. Because they've got the causality backwards. The Fed never leads the economy, ever. The Fed follows the economy. So a normal business cycle looks like this. So you get a little expansion going, and unemployment starts to go down, and industrial capacity utilization starts to go up, and inflation starts to go up. And the Fed's watching, and then it keeps going. And they go, it's getting a little hot. We better raise rates. And they raise rates, but of course they started too late. The expansion keeps going. Inflation keeps going up. Unemployment keeps going down. Then the economy starts to cool down. Unemployment goes up, and then prices go down, and capacity utilization drops, and we get into recession. Like, we better cut. And then they cut, and then you hit the bottom, and then you come out of it again. So think of that as like a nice, pretty sine wave, right? That's a business expansion, business contraction over and over, 30 or so times since the end of World War II, with the Fed always following the economy, never leading the economy. So all the big brains on Wall Street, they've got all this data, and they say, well, every time the Fed raises rates, the economy is getting stronger. That has absolutely been true for like 30 times since the end of World War II. It is not true today. The reason it's not true today is because Bernanke skipped the cycle, and they're playing catch up. For the first time since 1937, the Fed is tightening into weakness. That's a key thing to bear in mind. The Fed is tightening into weakness. They are not leading the economy to strength. They are not responding to strength, even though Wall Street thinks they are. And there's a great danger that they're actually going to cause the recession they're preparing to cure, as I mentioned. The Fed will raise rates 25 basis points 4 times a year from now until the middle of 2019, until they get them to 3.25%. So like clockwork, every March, June, September, December, for 2017, 2018, into 2019, look for a Fed rate hike until they get to 3.25%, at which point they'll be able to say, all right, now we're at 3.25. If we have a recession tomorrow, we can cut them back down to 0 again and get out of it. That'll be mission accomplished. Now, this is why I was sitting there in December like, yep, they're going to raise them in March. And right now, I'll tell your listeners they're going to raise them in June. There's your Fed response function. There's your baseline scenario. What are the exceptions to Fed rate hike? And under what conditions will they not raise rates? Because everything I just described to you, they've had in mind since March 2015 when Yellen took patience out of the statement. That was the end of forward guidance. And by the way, if you go back to 2015, I said they're not going to raise rates all year, and they weren't going to do the liftoff that people were looking for in March, June, September, and they didn't lift off in September because of the Chinese rate exchange devaluation. The stock market fell out of bed August 2015. Finally, they raised them in December 2015, and Wall Street was ready for March. I said no. In June, no. September, no. It wasn't until December 2016 that they raised them the second time. So obviously, there are conditions under which they don't raise rates, notwithstanding the baseline scenario. So what are those conditions? There are three. Well, four, actually. So if you see job creation below 75,000, that will cause them to pause. By the way, pause is the key word. If you go home through the speeches, you'll see the word pause in Dudley's recent remarks. Pause is the Fed's jargon for we're not going to raise rates. We got the Jim scenario, which I took from the Fed. It's their scenario. Or a technical recession. So, we're going to know Friday what the first quarter GDP is. It's pretty close to negative, but I'm not saying we're in a recession now. We might be. But if you see a recession, they'll pause. See job creation below 75,000, they'll pause. By the way, that's a very low bar. If you see a jobs report, see, this is the other thing that confuses Wall Street. You see a jobs report with 100,000 jobs, so Wall Street goes, oh, that report's really weak. The Fed's going to think twice. No, 75,000 is the number. Yellen told us that. It was in one of her speeches. You just have to be a geek like me and read all the speeches. So the third factor would be disinflation. So the Fed has this 2% inflation target. They've missed it for 6 years. They're finally getting close to hitting it. By the way, I think the listeners know they use the PCE core deflator year over year. There's PPI and CPI and core, a bunch of inflation indices, but we know what they use. PCE core deflator year over year. That actually has been getting close to 2%. But if you see it turn around, if you see that gap down to like 1.5, 1.4, 1.3, then they will pause. The last condition for the pause is a disorderly decline in stock markets more than 5%. If you see a 6, 7, 8% decline, so if the S&P went down 100 points, Fed doesn't care. Dow Jones goes down 1,000 points, Fed doesn't care. But beyond that, if you see the S&P start to go down 150 or the Dow start to go down 1,500 points in a disorderly way, it looks a little scary. It looks like there's no bottom. It looks like if you see that, they'll pause. So the Fed's going to raise like clockwork 4 times a year for the next 2.5 years, unless you see job creation below 75,000, disinflation, a technical recession. If you don't see one of those things, they're going to raise rates. And so right now, I don't see any of them. I mean, they could all happen, but it looks like, growth is going to be positive. Job creation's been decent, over 100,000. Disinflation is probably coming, but not quite here yet, and they'll want to see a couple months in a row. And the stock market's not crashing. So none of the pause conditions are in place. Therefore, they will raise rates. Simple. We're seeing something globally we've never seen before. And it is the best single indicator of a recession. The last time we saw anything like this was in 2007, just ahead of the 2008 financial catastrophe. So the stock market's saying it's all good, Goldilocks, soft landing, Fed's going to get the memo, they're going to cut rates, the pivot, and buy stocks. The bond market is saying no, this is bad and it's going to get worse, and it's actually too late for the Fed to do anything about it. But what happens is, as you get closer to the actual thing you're worried about, the inversion gets nearer and nearer. Now it is literally a month away or less. So that's like a big red siren, a flashing light, whatever you want to call it. Interest rates are a lagging indicator. Everyone's like, well, how could interest rates going up if we're in a recession? The answer is, as you get closer to recession, who figures it out first? Well, the Fed figures it out last. They're usually the last to know. Wall Street is second last to know. The people who figure it out first are actual business people, entrepreneurs, restaurant owners, dry cleaners, taxi drivers, or even medium-sized businesses. They see it. If you're in the trucking business, it's real time. Inventories are sky high and new orders are being slashed. You're not moving anything by truck. A lot of business people are living in the real world in real time. They know what's happening now, and the stock market tends to figure it out later. But as far as banking and credit is concerned, what happens is if you're a business person and you see business heading down, fewer customers, whatever, you go out and borrow all you can. You're like, hey, there's a really bad recession coming. If I got lines of credit, I'm going to use them up now. I don't want my bank changing the terms. I don't want material adverse average change clauses kicking in. Instead, I'm going to borrow everything I can. And that creates a demand for funds and interest rates go up. And then the recession hits and the bankers go, what's going on. Credit losses start going up, and then they just turn off the spigots and they raise standards. They stop doing loans, and then interest rates will start to come down. But interest rates peak after the recession has already begun. So stock market's telling us Goldilocks. Bond market's telling us, here comes, Hurricane Mitch or whatever. And then there's what I call the reality. What I see is a kind of a hybrid. The Fed's doing what they're doing, right or wrong. Okay, they're doing what they're doing. The market has their own interpretation. I agree with the market, certainly the bond market, that the Fed has probably over-tightened. They're going to keep going for the reasons I explained. That means they're going to make it worse. They're going to make the recession even worse. And they may pivot. To say that there could be a rate cut, it won't be in April, but, rate cut in August, maybe. I wouldn't rule that out. But for a really bad reason. In other words, if the Fed cuts rates, which they may, the pivot may be real. It's not because they engineered a soft landing and Goldilocks and everything. Oh, it's just right. It's because they screwed up as usual, as they've been doing since 1913. They over-tightened. They didn't look at the forward indicators I described, and they found out too late. Then they have to slam on the brakes, or take the foot off the brake, if you will, in terms of rate hikes, and then pivot. And we've seen this movie before. This is exactly what happened in 2018. I mean, I don't know. Attention spans seem to be short these days, but it wasn't that long ago. Go back and look at a chart, any stock index chart from October 1st, 2018 to December 24th, 2018. Less than 3 months. The stock market dropped 20%. I mean, it's like 19.9 or something on the Dow, so maybe not technically a bear market, but yeah, what's the difference? It dropped 20%. Culminating in the Christmas Eve massacre, December 24th, 2018, when it dropped, I think NASDAQ dropped like 3% in one day. Now, here's the point. The Fed was tightening into that collapse. The Fed tightened on December 16th, 2018, only like 8 days before the Christmas Eve massacre, and after most of the 20% collapse had already happened, they tightened one last time. So what it shows you is that when the Fed's on a mission, they actually don't care about the stock market. This whole, Bernanke put and Greenspan put and all that. That's not how it works. They don't care that much about the stock market level. Here's what they do care about. They care about disorderly markets, and that's the key word. It's not if stocks are going down, but it's kind of a little, 0.5% a day, 1% a day, trending down. Lower highs, lower lows, trending down. The Fed doesn't care about that. They're not going to bail out the stock market. They do care if it's disorderly. When was it disorderly? Well, March 2020, at the worst part of the pandemic. It dropped like 30% in like 2 or 3 weeks. The fall of 2008, I mean, it was like somebody opened a trap door. The Fed does care about that because that kind of disorderly behavior can feed on itself and end up in a 1929 type scenario. So the Fed will get the memo, as I put it, stop raising rates and begin cuts when the markets are disorderly, but not just because they're going down. So there may be a pivot, in late August, or July thereabouts, but not because of Goldilocks, but because it's not a soft landing, it's a crash landing.
But real quick, I guess, let's stick on the recession just for 1 second, because there's the, bad recessions generally come along with a lot of job losses. Do you see, given that this recession could be worse than most are expecting right now, there being, wide-scale layoffs of the sort we've seen in some of the bad previous recessions, like '08, like '01?
The answer is yes. First of all, we're seeing it already. I don't match the company to the exact number, but layoffs on order of magnitude 10,000 to 20,000 terminated employees at Google, Amazon, Facebook, and other tech names. It affects other sectors as well, but tech in particular has engaged in a massive series of layoffs. And so people go, well, wait a second, how come it hasn't shown up in the unemployment numbers? Because the unemployment rate is it's around 3.5, 3.6, I don't know the exact number. It's right in that neighborhood, 3.5, 3.6. We haven't seen that level of unemployment, that low, that is, since the 1960s. This isn't like, oh, a good year or a good debt. This is the lowest since the 1960s. And the Fed is absolutely looking at that. You're right about that, Adam. And they're saying, and of course, they believe in the Phillips curve, which is junk science. But the Phillips curve, for those who are not familiar, says there's an inverse relationship between unemployment and inflation. So if unemployment is high, inflation is low. And if unemployment comes down, inflation goes up. And so if you want to get inflation down, you should expect to bring unemployment up. That's what the Fed believes. What I just said is nonsense. It's not true. It's junk. But the Fed believes it. Again, it doesn't matter what I think. It matters what the Fed thinks. So you got to put yourself in their minds to figure it out. So as far as they're concerned, those kind of unemployment numbers, lowest since the 1960s, that's inflationary. They got to get those numbers up. Now, here's what the Fed is missing, or maybe everybody's missing. When you hear these layoff announcements, people are like, well, if they're laying off, why isn't the unemployment rate going up? Unemployment lags the business cycle. Unemployment is a lagging indicator. When you're an employer, entrepreneur, and you're in any kind of distress, not as many customers walking in the door, you'll do everything you can to avoid laying people off. You'll, be late on the rent. You'll turn down the lights. Find a cheaper laundry, whatever it takes. And then by the time you get around to firing people, you run out of options. Like, oh, I've done everything I can. Now my business is in jeopardy. I have to fire some people. So and then combine that with what I just said about severance and, rolling terminations, etc. It's a lagging indicator. We know enough right now to know that number's going up this spring. But that's not inconsistent with the fact that we're already in a recession. It's exactly what you would expect, that unemployment's a lagging indicator. Now, having said that, what else is the Fed missing? Well, wages are up 5% on an annualized basis, 5.2% on an annualized basis. I'm like, yeah, and inflation's 7% or 6%, so your real wage just went down 1 or 2 points. Because when the Bureau of Labor Statistics reports those wage numbers, those are nominal numbers. I'm not saying they're fake. But you have to know that they're nominal, and you have to subtract inflation to find out what's happening to real wages. And the answer is real wages have been going down for a couple of years because they runs around 5% annualized, give or take. Sounds like a 5% raise. What do you want? Well, yeah, but with 8-9% inflation, or even 6% inflation, your real wage is going down. So that's not a robust number at all. The Fed, by the way, wants to make it worse. The Fed agrees that those wage gains are too high. But my point is, in real terms, they're actually going down, but the Fed wants them to go down more. That would be one way to put it. If you get inflation down and wages are constant, then the real wage goes up relative to where it was before. But if you're unemployed, you have no wage. So that's another issue. Now, what the Fed is missing, and it's a long list, but there's something called the labor force participation rate. Now, the labor force participation rate, you just take the number of people working divided by the total working age population. That's all you do. It's not sophisticated. And that number today is around 61.2%, 61.2, give or take, percent. But as recently as 2000, that number was over 70%. And it has come down ever since, and it dropped like a stone during 2020, during the pandemic lockdown. Came back a little bit, but not much. The reason it got, first of all, it's never 100%. It shouldn't be. There are legitimate reasons to be working age population not working. You're a homemaker. You're a student. You're an early retiree.
You're in the military. Yeah.
You're in the There's a bunch of perfectly good reasons. So it's never 100%, not even close. But 70 is pretty high and 60 is pretty low. And the trend has been down. So that leaves, relative to kind of a normalized number, that leaves about 8 to 10 million people between the ages of 25 and 54 who are not in the workforce. There's a big untapped labor pool. But if you took that group and threw it into the unemployment numbers the way the Bureau of Labor Statistics calculates it, unemployment would be about 9%. And that's the depression level of unemployment. It's not going to take 7 years this time. It might be more like 7 months. And the reason is twofold. Number one, we're more leveraged and the stock market is more bubbly, and so the whole thing's more vulnerable. Number two, the market has seen this movie before. Like, hey, we watched this play out. We know it doesn't work. And the Fed balks. Now, so if the Fed suddenly slams on the brakes, says we're not going to keep raising rates along the lines I projected earlier, okay, that might give the stock market a boost. And you can't assume that won't happen. You got to watch for that. But I would expect that things would have to get pretty ugly in all events before the Fed got that message. On the other hand, if Powell gets confirmed and feels like it's his last term and here's his chance to be Paul Volcker and he's just going to keep raising rates, he said, my job is to get inflation under control. The rest of you people, you're responsible for fiscal policy and tax policy and spending and, shutting down the Keystone Pipeline.
Welfare.
And all that. That's on you, not me. My job is to get rid of inflation. If he does that, and he might, you're looking at a recession, kind of looks like the global financial crisis, and hope it doesn't. And there's a difference between extreme recession and financial crisis. They're two different things, but they can happen at the same time as did happen in 2008.
In this video, Jim Rickards talks about the challenges and potential risks faced by the Federal Reserve in managing the economy. The central theme revolves around the delicate balance that the Fed must strike between preventing a stock market crash and avoiding a severe recession. Jim raises concerns about the Fed's ability to have perfect information, citing flawed models and the possibility of being behind the curve in recognizing economic challenges. The distinction between a recession and a financial crisis is highlighted, with historical examples used to illustrate that these two phenomena can occur independently. Jim Rickards emphasizes the difficulty the Fed might face in choosing between preventing a financial crisis or accepting a recession as a trade-off. The reference to Paul Volcker's actions in the 1980s adds historical context, showcasing a deliberate choice to induce a severe recession for the purpose of combating inflation. However, Jim Rickards notes that the current economic landscape is more intricate, with additional considerations such as systemic risks and the potential for a recession triggering a financial crisis. In conclusion, Jim Rickards underscores the complex decisions the Federal Reserve must make, acknowledging the uncertainties and trade-offs inherent in steering the economy and avoiding undesirable outcomes. Before we get into the video, can you help me to give that like button a little touch? Alright, let's get into it.
Would the Fed back off if it became apparent that they were going to cause a stock market crash, a disorderly collapse, and a severe recession? The answer is almost certainly yes, but the problem is it might happen anyway. In other words, they might have gone too far, and this almost happened in 2018, and that was my point. There was by the time they realized their mistake, it might already be too late. So that's one danger. If they had perfect information, oh gee, we went too far, gee, we couldn't pull this off, we need to back off. They might back off exactly as you described, but they don't have perfect information. They have flawed models. They tend not to look at history, and they could
Behind the curve.
They could crash the car before they knew it was out of control. It's like slamming on the brakes on ice. You can slam on the brakes, but you're going to go for a long time before the car stops. So that's one problem. The second problem is you have to separate, as I said, recession, even severe recessions, from financial crises. In 1998, we had a financial crisis, but no recession. In 1994, we had a financial crisis, no recession. In 2020, we had a severe recession, no financial crisis. That was not a financial crisis. In 2001, we had the NASDAQ collapsed 80%, but there was only a very mild recession, and that was not a financial crisis. So the Fed might say, and again, might, because who knows, but they might say, well, of course we don't want a financial crisis. Now, to your point, Nick, nobody wants that, and they do get out of control. But we're not worried about that. You know, we learned our lesson in 2008. We had Dodd-Frank. And I had this discussion with James Gorman, the CEO of Morgan Stanley. I briefed their board, and they gave me a lot of pushback. They said, "Well, you don't understand, Jim. We have more capital and greater liquidity and less leverage and better credit." And I granted. I said, "You're absolutely right." I said, "Nice job. You're a stronger bank now than you were then." But in a financial crisis, it doesn't matter. The problem is systemic. In other words, as an individual bank, you may be better off. But if the whole system's collapsing, you can't necessarily withstand that. So they don't want that. But what if they said to themselves, you know what, we don't want a financial crisis, but we don't think that's going to happen. But maybe we'll just have to bear a recession. Volcker knew what he was doing. Volcker knew that there was going to be a recession. And the recession of 1981-82 that he caused was, at the time, the worst since the Great Depression. Now, we've surpassed that twice since then, 2008 and 2020, although it's hard to know what 2020 was. I mean, down 36% in 2 months and up 38% the next 2 months. I mean, what is that? But at least in technical terms, we've had two worse recessions, 2008 and 2020, since then. But at the time, and I lived through that. I was around. That was the worst recession. But Volcker knew that would happen. He said that's the price we have to pay to break the back of inflation, and he did. And by 1986, inflation was like 2% or 1.8%. Now, there was far less worry about financial crises at the time. Because remember, this was before the repeal of Glass-Steagall. Commercial banks, no one really cared about investment banks. They could fail, so what? They cared about the commercial banks, and they had a pretty good handle on that. So they weren't worried about financial crisis. But today you would be for the reasons we mentioned. So there are two possible major blunders here, but don't underestimate the Fed's ability to do both. One is that they could decide they don't want a recession, but not know until it was too late. They just tighten into it, don't know it until it's too late, and then the damage is done. The other one is they could sign up for a recession, say, yeah, sorry, but that's the price of getting inflation under control, and trigger a financial crisis that nobody wants but could happen anyway. So, it's kind of so and Charybdis, take your pick. Severe recession, but we know it's coming. Recession that causes a financial crisis that we didn't want, or just let the inflation rip. What's the good outcome there? What's the good one?
Yeah.
But I think those are the three choices. I think you're right.
In the face of these complexities, our discussion leaves us with three potential scenarios: the risk of unwittingly tightening into a recession, the prospect of accepting a recession for inflation control, or the challenging choice of allowing inflation to run rampant. The Federal Reserve stands at a crossroads, and the decisions they make in the coming months may well shape the economic landscape for years to come. As we conclude our exploration, it becomes clear that the path ahead is fraught with challenges and decision-making. The balancing act between preventing a stock market crash and avoiding an unintentional recession places the Federal Reserve in a formidable position. The lessons from 2018 serve as a stark reminder that perfect information eludes them, and the consequences of their decisions may only become apparent once it's too late to correct. The historical perspective sheds light on the dual nature of economic downturns, where financial crises and recessions don't always go hand in hand. Drawing parallels to Paul Volcker's bold strategy in the 1980s, we ponder whether the Fed might consider accepting a recession as a necessary sacrifice for taming inflation.
But the bigger question is, why on earth is the Fed raising rates when the U.S. economy is on the brink of recession? When the U.S. economy is hanging by a thread, you don't raise rates in a weak environment. You raise rates when, the economy's hot, unemployment's, lower than it is, but inflation is taking off, things look speculative, and then you raise rates to cool it down a little bit, and then when the market cools down, unemployment goes up, inflation falls, then you ease, then you cut rates. And the Fed never leads the markets. The Fed always follows the markets. The Fed's always working with a lag. So why on earth are they raising rates in a difficult, challenging economic environment? And the answer is, they're doing it for the wrong reasons. They are desperately trying to raise rates so they can cut them in the next recession.
Yeah.
The history is that you need to cut rates 300 or 400 basis points, 3 or 4%, in other words, to get the U.S. out of a recession. And typically the way it works is you go into a recession at, 6.5% interest rates. You cut them 3% down to 3.5%, maybe a little more, and then that's enough to get the economy out of the recession. Well, how do you cut 300 basis points when you're only at 25 basis points? Well, you can't, obviously. They're trying to raise rates so they can cut them. I say this is like hitting yourself in the head with a hammer because it feels good when you stop. But the Fed's conundrum is, how do you raise rates enough so that you can cut them in the next recession without causing the recession you're trying to prevent? That's the conundrum, and I think the answer is you can't do it. They're going to cause the recession. The Fed is not neutral when it comes to raising rates. They are biased in favor of raising rates. So it's not the case. When they wake up in the morning, they're not asking themselves, do I want to raise rates? Do I not want to raise rates? What's the data dependent, all this stuff. They wake up and say, I want to raise rates. Can I? In other words, just because they want to raise rates doesn't mean the coast is clear. So I analogize this to a little kid who's trying to steal money from mom's wallet. If mom's looking, they won't take it, but if mom's out in the backyard, they'll go grab some money. So the Fed will raise rates whenever they think they can get away with it. So they want to raise rates. They can't always raise rates if they think things are iffy, or the markets don't expect it, or financial conditions are already too tight for other reasons, they won't do it. But if the coast is clear, they will. When you throw out a phrase like world taxation, we talked a little bit earlier about world money, the SDR, and the initial reaction on the part of some readers is to roll their eyes and go, oh, there goes Jim again with all his crazy conspiracy theories. But these are not conspiracy theories. Again, I make the point. This is very, very important. This is all documented. This is all happening. You can go to these websites. You can attend these meetings. You can look at these working papers. It's all real. Now, as far as world taxation are concerned, we said earlier they love these crazy acronyms that no one understands unless you're expert on all this. But the key phrase here is BEPS, B-E-P-S. That stands for base erosion and profit shifting. So base erosion and profit shifting are the bad things that corporations do to get out of paying taxes. And the governments are going to lead an attack on BEPS, attack on base erosion and profit shifting. And this is all being directed by the G20. And of course, the G20 is this world leadership. It's basically the board of directors of the world. That's the easiest way to describe it. The G20 operates like a board of directors, but they don't have a big staff and directorate. But what they do is they farm out these projects to different existing agencies. It could be the United Nations, it could be the IMF, but we have another group called the OECD, Organization of Economic Cooperation and Development, based in Paris. This is a kind of a rich country's think tank, and the G20 have given the OECD the task of coordinating and implementing BEPS, the BEPS project. And the way it works is, let's say you have an invention, but you invent it in the United States. Well, if you patent that invention and license it for royalties, and all those royalties come to the United States, you're going to pay U.S. tax on it. But what if you take the invention and contribute the intellectual property to an offshore company, and then that company then does all the global licensing? And now all the licensing fees go into Dublin instead of Seattle, and you're not paying any tax there because you got a special deal with the Irish government. Well, that's the kind of thing that's going on. Many, many more complicated examples than that, but that's a simple one that makes the point. The other thing that's done is you mess around with debt equity ratios. So I've got an offshore subsidiary, and instead of giving a capital, I borrow a gazillion dollars from it and pay them interest. Well, what's happening with the interest? Well, it's a deduction in the U.S., and it's income in, say the Bahamas, right? So I get a nice fat tax deduction in the U.S. The money goes to a tax-free jurisdiction like the Bahamas, but I'm just taking it out of one pocket, putting it in the other, right? Because I own both companies. And the corporations are moving this money around so fast that nobody can keep track. So what the governments have decided to do is join forces. And they're going to create this global tax network. And they're going to say to every major corporation, you're going to have a global tax ID, not just your Social Security number, the corporate equivalent. You're going to have a global tax ID, and all of your subsidiaries are going to have IDs, and all of your transactions are going to have IDs. And all this information is going to be reported to a database to whatever country has jurisdiction. But then all the countries are going to share all the data using this unified ID system and then put it into one giant supercomputer and that everybody can access. So now all of a sudden, Germany's going to be able to see the other side of the trade. They may know that a German corporation is paying interest, but they'll be able to learn that the interest is going to an affiliate in Hong Kong that's not paying any taxes, etc. So they're going to have the complete picture. And then once you have the picture, you can attack it. You can use anti-avoidance provisions. You can use special laws and Section 269 of the Internal Revenue Code. I mean, they're equivalents all over the world. They have the tools, but what they don't have is the information. Under this BEPS project, they're going to get the information. And then they're going to combine the information and the tools, and then they're going to tax these corporations. And they'll be able to run, but they won't be able to hide. And then they're going to raise the rates. And then a lot of people say, well, what's wrong with that? Why shouldn't they pay their fair share? And my answer is, you should pay your fair share. But what's fair? So this is a full-scale assault on the ability of corporations to legally avoid taxes, but it's going to segue into something that's much more punitive, much more extractive. But when you look at interest rates, you have to distinguish between nominal rates and real rates. Now, I'll give you an example. In 1980, I got my first mortgage on a condo in New York, and I paid 13%. And my mother cried. I mean, her first mortgage was like 3%. And here I am paying 13% on mortgage. My mother was upset. She thought that was like a dumb decision. But I said, Mom, I'm paying 13% interest, but inflation is 15%, and taxes are 50%. So my after-tax cost of funding is 7, inflation's 15, my real interest rate is -8. The bank is paying me to borrow because I get to pay them back in cheaper dollars. Whereas today, even with, say, a 4% mortgage, if inflation is only 1.5%, which it is, that's a positive real rate of 2.5%. So when I borrowed at 13%, the real rate was -5%. Today, when you borrow at 4.5%, the real rate is +2 or 2.5%. So nominal rates are at an all-time low, but real rates are very high. And that's what drives economic decision-making, and that's what drives the economy. And one of the problems that economists and policymakers are wrestling with is how do you get real rates negative? Because that's what stimulates borrowing. If I think I can go borrow money and pay it back in cheaper dollars so that the real cost is negative, I actually get free money from the bank or the bank pays me to borrow. That's what a negative interest rate means. That's supposed to be a prod or a stimulus to more investment, more R&D, and more consumption, and more economic activity, and higher aggregate demand.
Kemana lah HP Mima itu hilang, ha? Hah? Gak tahu. Carilah HP-nya. Hilang-hilang terus loh. Tiranto hilang, ini hilang. Gimana Mima terakhir pakai HP-nya? Hah?
Nggak tahu. Lupa.
Mak, nggak dapet loh HP-nya ini loh, Mak. HP Bima itu. Nggak nampak tadi mana taruhnya. Bima apain HP-nya nih Bima? Ini kenapa bisa loading terus dia m-bankingnya? Kok nggak tahu Mima apain tadi malam ini? Nanti Mima apa nggak upgrade iOS gak?